What matters is threefold, though. First, a split is a sign to regular investors, okay, that the company's doing well, better than we thought. Now, we can try to stamp that thinking out, but it won't work. That is always you hear it on the lightning round. People always call about that. I could tell them, hey, listen, you're dumb, you're wrong. I'm not doing that. I'm not bigger than the concept. Second, individuals who don't want the clumsiness of fractional shares, and they are clumsy, will eagerly start buying when they finally get a chance to pick up 10 shares of a juggernaut like Google. And finally, given what this company's brainiacs know about you, about consumer preferences, this is a decision that will have very wide implications. Alphabet knows you better than you know yourself. They have your search history. So if they think a 20-for-1 stock split is a good idea, they're going to be right. Other CEOs will begin to question why they have to bend over backward to satisfy institutional investors, hence this term institutional bias, with high dollar amount stocks. Remember, when money managers buy or sell stock, they pay commission by the share. So it's always going to be cheaper for them to buy 10 shares of Google at $2,960 than it would be to buy 200 shares at $148. So the institutions have browbeaten all the CEOs and CFOs into going their way and letting these stocks get to prices that you and I can't afford. And that drives me crazy. Now, this is all fabulous news to someone who's always trying to get people into the stock market, especially individual common stocks of high-quality companies, rather than high-risk, out-of-the-money call options or idiotic ETFs. Just average. I see them endlessly just to capture the flavor of the day. I think that they are they just annihilate your capital. At the same time, big tech companies that have refused to split their stocks are an anathema to ordinary investors. I think Google has finally realized that ordinary investors actually make for a great shareholder base. These people, including you who watch the show, and this is who I'm talking about, of course, you don't dump the stock on the first sign that the cost of user acquisition has jumped, or that Waymo's self-driving car technology is delayed, or Google Cloud didn't make an additional $50 million. You're in for the long haul. That's who they should want. Maybe the companies are starting to get it through their thick heads that they should want you as shareholders. In the old days, the stock split was a badge of honor. It meant your stock had broken out of the pack and wanted to keep getting sponsorship from individual investors. Every study I've ever seen tells me that when stocks split, they go up big on the announcement and then they stay up. Now, I know it makes no sense mathematically. Once again, you do not get a larger pencil, okay? But the stock market runs on emotion, not on math. Yet a stock split like this tells investors that Alphabet is rewarding people for sticking with it. You don't see a lot of $10 or $20 or $30 stock splitting. What's the point? The bottom line, if a company like Alphabet can split, all right, anyone can. And I think everyone will. And if the geniuses at this company who knew better than we know ourselves say split, then I think we'll end up welcoming a whole new cohort of investors to the market, one that's been missing out for years. People with enough disposable cash to buy 10 shares of a $150 stock, but not enough money to buy one share of a $2,900 stock.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.